Chapter 6: Fundamental Analysis Uncovered. Buy great companies. How do you determine what a great company is and how much you should pay for it? Is a great company one that is environmentally friendly? Is it a company that sells a lot of merchandise? How about a company that treats its customers and employees right? A great company, in the context of buying it as an investment, is a company that consistently generates a healthy net income. Not only that, it should also be able to increase its net income year after year. The net income of a company is the bottom line. It's what's left over after all the expenses, interest, and taxes have been deducted from the revenue the company generated. Total revenue generated has an impact on the net income of a company. So, in order to increase its net income year after year, one thing a company can do is to increase its total revenue, which is the company's gross income from its sales of goods or services. To increase revenue, a company can sell its product at a higher price, increase its customer base, example, sell products in a different country, sell more of the same product to existing customers, create new products to sell or buy existing ones from the competition. If a company can increase its total revenue while management efficiently keeps cost and other liabilities in check, the extra revenue generated from sales will have a positive impact on the bottom line, net income. You want to look at total revenue and net income year over year for the last 5 or 10 years and see if the company has been able to consistently increase both. Focusing more on the last 5 years will give you a better picture of a company's recent performance. If a company has been able to increase total revenue year after year by, let's say, 3%, but the net income has stayed flat, that could be concerning. It could be that management has been taking a bigger salary, the company might be taking on more debt, hiring on new employees, expanding the business, etc. If total revenue is staying flat or slightly declining, but net income is increasing, that might be a concern also. It could be that the company is losing market share to a competitor, or the products or services they sell are losing customer appeal. So, management is doing some internal restructuring to keep the company afloat. Let's look at examples of 2 great companies and 2 other companies I would refrain from investing in. Fastenal, FAST, is a company that sells industrial and construction supplies to businesses and retail customers. The company started as a partnership in 1967 and has been so successful that it has expanded beyond the U.S. Take a look at both the total revenue and the net income graphs in Figure 6.1, Fastenal total revenue 2005 to 2014, and Figure 6.2, Fastenal net income 2005 to 2014. Both total revenue and net income have been growing at a steady pace. There was one year when both took a dip. This was in 2009 when the recession hit, but a great company can bounce back and continue generating a healthy income because of its competitive advantage. Also, notice how both the total revenue and net income move in a symmetrical fashion. The increase in total revenue had an immediate impact on the bottom line, net income. Let's look at the next one, Estée Lauder, EL, founded in the mid-90s, a company that sells cosmetic products in high-end fashion stores. Their products are sold all over the world, and they own brands such as Tom Ford and DKNY. See Figure 6.3, Estée Lauder total revenue 2006 to 2015, and Figure 6.4, Estée Lauder total net income 2006 to 2015. Total revenue is seeing a consistent increase year over year, but look at the net income. It has taken off since 2009. What's happened is that they have been able to increase their profit margin from the single digits into double digits. To calculate profit margin, you take net income divided by total revenue. See Table 6.1 Estee Lauder Profit Margin 2008 to 2015. Now let's look at two companies I would refrain from investing in based on their performance for the past years. Sprint, S, is a company that operates in the wireless communication industry, offering both wireless and wireline products to its customer base. Other competitors are companies like AT&T and Verizon. See Figure 6.5 Sprint Total Revenue 2005 to 2014 and Figure 6.6 Sprint Net Income 2005 to 2014. Sprint's total revenue hit its peak around $40 billion in 2006-2007 and has been on the decline since then. Sprint's net income is not any better. The company has been operating at a net loss since 2007. When a company performs with these kinds of numbers, it will reflect in its stock price. Let's look at American Airlines, AAL, a well-known airline of many frequent flyers. AAL also owns U.S. Airways and Envoy Aviation. American Airlines flies all over the world. See Figure 6.7 American Airlines Total Revenue 2005 to 2014 and Figure 6.8 American Airlines Net Income 2005 to 2014. American Airlines total revenue doesn't look too bad. They took a hit during the recession, but have been able to increase their revenue since the recession. Their net income, on the other hand, is nothing to brag about. They have generated a net loss for a good many years and just recently got back in the green. No consistency at all. A company that only generates losses is a company that could eventually go bankrupt if management does not make drastic changes. A company like this might also be bought out by the competition. It could also be a company that is still in the growth phase. These are companies I avoid. The last two companies were companies that both operated at a net loss for many years. The net loss itself is a dead giveaway for me not to invest in such a company, but what I'm looking for is consistency of growth. There might be a year or two where the company underperforms, but great companies can get back on track. So what I look for is a consistent upward trend of increasing revenue and income. Competitive advantage. A great company should have, as Warren Buffett has coined it, a moat. This is the competitive advantage a company has over its competition. This advantage allows the company to dominate its industry, to pull the company out of financial turmoil, and to keep customers constantly coming back for its products or services. It's the unique path a company has carved for itself that sets them apart from the competition, and it also breeds customer loyalty. If the customer wants this specific product or service, they can only get it from this company. The competitive advantage, or moat, could be a brand name, like Colgate, CL, for toothpaste. It could also be Johnson & Johnson, J&J, that sells brand name products like its baby lotion. Let's not forget Coke, KO, which has been selling pretty much the same soft drink for over 50 years. A competitive advantage could also be a high barrier to entry in a specific market or a geographical monopoly a company has. There is no substitute for a company's moat. If you want to eat a Big Mac, you can only get it from McDonald's, McD. The same goes for Pampers diapers from P&G, PG, or Gatorade from PepsiCo, PEP. One way to determine a company's moat is to ask yourself if the customer would buy a different product or service if the company increased its price. So if Coke increased the price of their bottles from $1 to $1.10, would the customers still buy Coke, or would they buy the off-brand? There are many services and products offered that customers buy based on the price of the product alone. The business that can offer the lowest cost will get the customer. Commodities such as sugar, cement, or cocoa are bought mostly based on price. The same goes for flights and automobiles. That's why these companies have historically been horrible investments. When comparison shopping flights online, most people go with the cheapest option. Even though this is also mostly true for cars, there are a couple of car companies that have been able to create a moat for themselves. Think about a company like Ferrari SPA, which has carved out a niche for being a luxury sports car brand for rich people only. The vast majority of car shoppers, however, are very price aware when shopping for a car. Also, there are a couple of companies that sell excellent products. These products are so entrenched in society that the companies that own these products have been able to sell the same product year after year, decade after decade, without making any or slight changes. Coke, Pepsi, Tide, Bounty are some to name a few. The Coca-Cola Company has been selling the same Coke for decades now. Coca-Cola does not have to do research and development or update their product, which all cost money. All Coca-Cola has to do is sell their product, something they do very well. These products are cash cows and benefit shareholders greatly. I always look at owning companies that sell these types of products. It's a guaranteed dividend machine. Just ask yourself this question: has this company been able to sell the same product for at least the last 10 years? Responsible management. Always look for a company to invest in that has a good management team running operations. You won't be able to see what management does day by day, but there are other ways that you can check up on their performance. One telling sign is to see if the company can increase its shareholder equity, net income, and be able to keep debt in control and increase their profit margin. The best way to check on management is to see how the company has performed in the past few years. This gives you an indication of how productive management is. Stock buyback. I look for companies that buy their shares back. If you own shares of a company that buys their shares back, you have a couple of benefits working for you. First, your ownership in the company increases. If a company has 1 million shares outstanding and you own 10,000 shares of that company, you own 1% of the company, 10,000 over 1 million. If the company started buying their shares and there are now only 400,000 shares outstanding, you still own your 10,000 shares, but your ownership in the company has just increased to 2.5%, 10,000 over 400,000. The second benefit is that you did not have to buy any additional shares or pay taxes for your ownership in the company to increase. The third benefit is the company has been able to increase its earnings, which could potentially increase the price of the stock on the market. Let's say this company generated $1 million in net income. The earnings of a company are the net income per share. So with $1 million in net income and 1 million shares outstanding, the earning of the company are $1 per share, $1 million over 1 million shares. If the company bought their stock and now had 400,000 shares outstanding and they still generated $1 million in net income, the earnings of the company are now $2.50 per share, $1 million over 400,000 shares outstanding. To see if a company is buying back its shares, all you have to do is look at the total amount of shares outstanding for the last 5 or 10 years. If you see the amount of shares outstanding decreasing, that means a company is buying back its shares. See image below in Figure 6.9, Kimberly-Clark stock buyback. As you can see, a company as Kimberly-Clark has steadily been buying back its shares year after year. Pay off debt. Debt is not necessarily a bad thing. Companies often take on debt to expand their core business. Problems arise when a company takes on more debt than it can handle. Debt is also a major profit killer in economic downturns, which could leave your dividend in jeopardy to be cut or frozen. The debt-to-equity ratio is a popular ratio used to figure out how much debt a company has in relation to its shareholders' equity. DE ratio equals total liabilities over equity. A high debt-to-equity ratio is if a lot of debt is used to finance the company. There is no hard or fast rule, but I like to see a consistent DE ratio below 1. Some industries, however, always have a higher DE ratio. Another way I analyze a company's debt situation is by trying to figure out how many years it takes for a company to pay its total liabilities with the income it generates before taxes. We want to see 5 years or less. For example, McDonald's had a DE ratio of 1.17 in 2014. I then take total liabilities over net income before taxes equals 3.34, 21.4 billion over 6.4 billion. So McDonald's could pay off its debt in less than 4 years, additional interest expense not accounted for. Return on equity. The return on equity formula is a great way to find excellent companies. ROE tells you how much net income is generated based on shareholders' equity. This is easy to calculate. ROE equals net income over shareholder equity. The greater this number is, the more income a company has been able to generate using equity. ROE tells you how well management is working on taking equity and generating a healthy profit. ROE is also a great indicator of a company with a competitive advantage because they will have a consistently high ROE. If you had $20,000 and invested $10,000 each in 2 companies, your shareholder equity is $10,000 per company. Company A was able to generate an income of $1,000 and Company B $3,000. Your ROE for Company A is 10%, $1,000 over $10,000. Company B ROE is 30%. Based on this example, you can already guess that Company B is the winner because it has been able to generate more income, but we're not done yet. Both companies decide to pay out 50% in dividends, and the rest is retained in the company, retained earnings. Company A's dividend is $500. Company B's dividend is $1,500. The retained earnings are added to shareholders' equity. Company A, $10,000 plus $500 equals $10,500. Company B, $10,000 plus $1,500 equals $11,500. The next year, both companies had the same ROE, 10% and 30%. Company A generated $1,050, 10%, and B, $3,450, 30%, and both paid out a 50% dividend again. Company A, $525, Company B, $1,725. The rest is retained in the company and added to shareholder equity. Company A, $10,500 plus $525 equals $11,025. Company B, $11,500 plus $1,725 equals $13,225. As you can see, not only is Company B able to pay a higher dividend, they are also able to grow their net income and shareholder equity at a higher rate than Company A. This is why you always want to invest in companies that have a consistently high ROE. Look for companies that generate a ROE in the double digits. Because companies can manipulate ROE in their favor, I also look at the return on invested capital, ROIC. This shows how profitable a company is based on its invested capital. The calculation is net income minus dividends over total capital. I look for ROE and ROIC in double digits. See Table 6.2, Genuine Parts Company ROE and ROIC. The Annual Report. Every single company that is publicly traded is obligated to report its performance to its shareholders. Companies post their annual and quarterly reports for their investors on their website. Annual reports, also called a Form 10-K, can be found online or you can request them from the company also. Annual reports are structured. They usually start with a shareholder's letter from the CEO on how the company has performed the last quarters. Then you get a detailed overview of the company's business, risk factors, and so forth. There are plenty of companies that have a habit of beautifying their annual reports. So whenever you're looking at an annual report, don't be fooled by all the smiling faces, skip past all the pretty pictures and smiling faces, and go directly to the necessary information, which are the financial reports. See Figure 6.10, Publicly Traded Companies' Financial Statements. These three reports, income statement, balance sheet, and cash flow statement, have all the company's financial data you need. The income statements show the profitability of a company for a specified date range. The balance sheet lists the assets a company has, such as buildings and equipment, liabilities, short-term and long-term, and the equity of the shareholders. This report always needs to be balanced. The cash flow statement gives you a picture of how the company is using its cash to operate the business. Instead of browsing through all these annual reports for different companies, I use sites like Yahoo Finance, MSN Money, and Morningstar. Morningstar is my go-to site for financial information. It's always best to double-check the financial numbers on Morningstar to the financial numbers in the annual reports, but I've noticed that Morningstar is highly accurate. The benefit of Morningstar is that it shows the important financial metrics of publicly traded companies for the last 5 or 10 years. So you don't have to page through the different annual reports of the same company to make sense of all the numbers. This speeds up the process of analyzing companies. You don't have to be an accountant to read through these financial reports, but it does help to have a basic understanding of them. Analyzing the dividend. When analyzing the dividend a company pays out, the first thing you need to look at is if the company has paid out a dividend in the last 10 years. The reason for this is that it will show consistency in paying dividends even in times of economic downturns. Secondly, the company needs to have increased the dividend on average faster than inflation, or at least keep up with it. This will allow your dividend to keep its buying power. Third, look at a company's earnings per share and compare it to the dividend paid out to shareholders. Your dividend is paid out of the earnings of the company. If a company made $1 million in net income and had 500,000 shares outstanding, the earnings per share would be $2, $1 million over 500,000. The company decides to pay out $500,000 of the net income out as a dividend. Per share, this is $1, $500,000 over 500,000 shares. If you owned 800 shares, you would receive $1 for each share you owned as a dividend, so that would be $800 total in dividend income. A company that can increase its net income or earnings per share will also be able to increase its dividend if the board of directors agrees on increasing the dividend. The movement of the stock price on the stock market is influenced by many factors, such as fear and greed of investors, but is also influenced by the company's earnings. Companies post their earnings for the quarter. If a company misses its earnings goal by even a few pennies, it could hurt the stock price. If the company was able to beat its projected earnings, there is a likely chance that the price of the stock will increase. An increase in earnings is especially important to investors that are investing to receive dividends. Since dividends are paid out of earnings, which are net income per share, if the earnings increase, board directors will increase the dividends also to keep their shareholders happy. See Figure 6.11, Fastenal Earnings and Dividend 2005 to 2014. Fastenal has been able to grow its dividend above 20% on average year after year in the last 5 and 10 years. See Figure 6.12, PepsiCo earnings and dividend 2005 to 2014. PepsiCo has been able to grow its dividend by 7.3% on average year after year in the last 5 years, and 10% on average in the last 10 years. Not as spectacular as Fastenal, but it's growing faster than inflation, and that's all that matters. Many investors, like Warren Buffett, like using a discount model to project future earnings. This will give them the confidence to buy a stock at a certain price. To me, a discount model leaves too much margin of error. You can never predict the future, but I can guess by looking at the past performance of the companies I want to invest in. That is why consistency is extremely important. A company like Fastenal has been able to consistently grow its earnings around 14% on average every year for the last 10 years. They've also consistently been able to keep their ROE and ROIC above 20% and also have a low amount of debt. The company also has a competitive advantage. It's the consistency of companies that gives me the confidence to invest in them. If I am analyzing companies but notice that their earnings were erratic and their ROE and ROIC were inconsistent, I would not be confident investing in the company. Payout ratio. Looking at the Fastenal and PepsiCo graph, again, you can see that the companies that increase their earnings can safely increase their dividends also. The amount of dividend a company pays out compared to the earnings is called the payout ratio. For the year 2014, PepsiCo had total earnings per share of $4.27. It paid $2.53 out as a dividend. The payout ratio is 59.25%, $2.53 over $4.27. A good payout ratio depends on the company and the industry it is in. Some industries like REITs and utility stocks have historically had a high payout ratio. I typically look for companies that have a payout ratio of 60% or less. Consistency, as always, is key. See Figure 6.13, PepsiCo payout ratio. Pepsi has been able to consistently keep the payout ratio below 60% in the last 10 years, even through the Great Recession. If you notice that a payout ratio keeps climbing and is getting closer to 100%, it means that almost all of its earnings are paid out as a dividend. This is not good, because a company needs to retain a certain amount of earnings to invest back in the business. See Figure 6.14, McDonald's payout ratio. Looking at McDonald's payout ratio, you can see that their payout ratio has seen a steady increase from 30% in 2005 to over 70% in 2015. The past few years, McDonald's has struggled to acquire new customers, and they have been losing customers to healthier fast food restaurants and shops like Subway and Chipotle. They've seen their total revenue and gross profit take a small dip in the last couple of years. They've been increasing their dividend at a higher percentage than their earnings growth. This is not a deal breaker, but it is something to pay attention to. Dividend yield. A dividend yield is the percentage of dividend you receive compared to what the price of the stock is. So, if a stock sells on the market for $40 and the dividend per stock is $1, your dividend yield is 2.5%, $1 over $40. Higher yield is better, right? Not necessarily. Usually with stocks that pay a high dividend yield, 5% or up, they either grow their dividend at a slower pace or there might be something going on with the company that made their stock price drop, like missing their earnings goal by a few pennies. The lower the share price drops, the higher the dividend yield will be. So, in our previous example, if the dividend is still at $1 a share and the share price tumbles to $25, now the dividend yield is 4%. Not all, but many companies that pay a high dividend also have a high payout ratio. See Figure 6.15, Verizon payout ratio. Verizon has a 5.03% dividend yield and an average payout ratio of 90%. This means that they pay out 90% of their earnings out to shareholders in the form of dividends. They have been growing their dividend at a rate of 2.9% over the last years. 2.9% is not flattering, but one benefit with high dividend yielding stocks is that you get a higher dividend income up front that you can use to reinvest or buy other stocks. So what is better, higher yield low growth or lower yield high growth? I lean toward lower yield faster growth, but honestly, I have both in my investment portfolio. Keep in mind, however, that if the economy goes through a slump and stock prices start declining across the board, many stocks will have a high yield. This is the optimal scenario to buy great companies and receive a high-yielding dividend. Many companies with a competitive advantage can increase their dividends without having to sell more products or services or find new customers to sell to, even if their customer base is small. For example, a company that sells potato chips sells an 8-ounce bag for $1. They have a customer base of 100,000 people that love their potato chips. Every customer just buys one bag, which gives this company a total revenue of $100,000. Total expenses for one bag end up being 80 cents, which leaves the company a net income of $20,000. 20 cents times 100,000 bags sold. The company decides to pay out a 50% dividend, so shareholders receive a total of $10,000 in dividends. The following year's cost per bag has gone up to 90 cents. The company decides to pass the cost on to its customers and sells the same 8-ounce bag for $1.15. They still have the same customer base that buys one bag. Now their total revenue is $115,000. The company's net income is $25,000. They stick with the 50% payout ratio and end up paying $12,500 total in dividends. The company was able to increase its dividend by 25% without having acquired new customers or selling more potato chip bags. So whenever you go into your local grocery store and notice that the prices on your favorite products have increased, now you know why. Companies with a competitive advantage can raise their prices year after year and also raise the dividends they pay out without acquiring new customers. We've looked at a couple metrics that can be used to analyze a company. Are these the only metrics? No, but these performance metrics give you a high-level overview of how the company is performing. If anything seems off, I can always dive in deeper and comb through the financial statements. This, however, is something that I rarely do, because that's way too boring. I just stick to the high-level metrics, because anything that might affect performance in a bad way will filter to the top and I will notice it either by the P/E ratio dropping, the price of the stock tumbling, peak earnings report, dip in revenue or net income, high debt level, or any other bad circumstances that could pop up. I also lean on a company's competitive advantage, pulling it out of any business turmoil it might go through, and I keep an eye on the 5 to 10 years performance. How much to pay? You go to your local grocery store and you see your favorite chocolate candy bar selling for $3. You are used to buying it cheaper than $3, so you decide not to purchase it that day. You go back to the store after 1 week and you notice that the price of the same chocolate candy bar is now on sale for $1. You freak out and start loading up on chocolate candy bars because you've never seen it this cheap. That's the same way you are going to be buying dividend stocks when you can get them at a deep discount. How much you pay for a stock depends on the value of the stock itself. You don't just buy a stock because you like the company. You should only buy if the stock is trading at a deep discount compared to its value. Right now, Walmart has a market cap of $189 billion, and Chevron has a market cap of $167 billion. If I gave you $190 billion today and told you to buy the company that's the better deal, Which one would you buy? Why? Would you buy Chevron because it looks cheaper compared to Walmart? Always look at buying stocks as if you're buying the whole company. If you take that perspective, you will be more diligent in your research on deciding which company's stock to buy. Also, if you wouldn't buy the whole company if you had the capital, don't even think about buying even one share in the company. To figure out which of the two companies we would like to buy and how much we want to pay for it, we need to decide the value of a company first. There are two ways: book value or net income. The book value is the tangible worth of the company, and this is also what shareholders would get if the company gets liquidated, sold. Book value is calculated as assets, liabilities. Book value may look like shareholders' equity, but it only contains tangible assets that can be sold. Intangible assets like goodwill or brand recognition cannot be sold. Net income is the second and my most favorite way of valuing a company. The amount of income a company generates tells me how much I am willing to pay for it. Since we are looking to invest in profitable businesses that should not get liquidated, we will use the net income method of valuing a business. Let's scale it back a little bit with a fun short story. A group of kids in your neighborhood are very assertive and entrepreneurial. They started their own lemonade business, where they've set up lemonade stands in the local community. All year round, they meet plenty of thirsty customers, and they can generate $10,000 in net profit. They sell lemonade for 50 cents a glass and make 25 cents profit. So they are selling more than 100 glasses a day to reach that $10,000 profit. After doing this for a year, they are getting tired of standing outside in rain, sleet, or snow and would rather be sitting at home playing video games all day. Games they bought with their lemonade money, of course. You offer to buy the lemonade business from them and have your nephews running the day-to-day operations. They got in a huddle and did some quick math. If the lemonade business makes them $10,000 a year profit, it would be foolish to sell it for less than that amount, because they would have incurred a major loss. If they sell it for $10,000, they haven't made any profit, because they can do those numbers in a year. All things being equal, if their expenses and profits stay the same year after year, they decide to sell the business for $100,000, which is 10 years' worth of profits. So the young entrepreneurs decided on $100,000. They think that amount will buy them video games for a lifetime. Now you, on the other hand, want to get the business as cheap as possible. If you can get it for $5,000, you will be up 100% the first year, because you spend $5,000 and the business generated $10,000. If you can buy their business for $10,000, you are also a winner, because you will have made your money back in just 1 year. Everything after year 1 is just pure profit. You are eventually able to negotiate the price down to $50,000, which means that you will make all your money back in year 5 or a 20% immediate return of your investment, $10,000 over $50,000. After year 5, everything you earn is just pure profit, and you can use the money to buy a different business. There is a specific formula that investors use called the P/E ratio. It shows you how much money you pay for $1 profit a company generates. P stands for price, and E stands for earnings. We paid $50,000, P, for the lemonade company, and the company had a net income or earnings of $10,000, E. So you take the earnings and divide that by the price to get the P/E ratio. $50,000 over $10,000 equals 5. For every $5 you spend, you bought $1 in profit. The same way we valued the young entrepreneur's lemonade business is the same way we will evaluate the big businesses on the stock market, like Walmart and Chevron. Don't forget that when we invest, we are looking at our initial return and how many years it will take to get our original investment back. We're going to do two things. We're taking the market cap of the companies, which is the total value of the company on the stock market, and break it down to a single share price, and we will take the net income and break it down to income for a single share. The market cap for Walmart is $189 billion. They have 3.2 billion shares outstanding, so to break it down to a single share price, we take $189 billion divided by 3.2 billion shares outstanding equals $59.08. $59.08 is also the price that you will see on the stock market when people are talking about the share price of Walmart. Walmart generated $14.912 billion in net income. To break it down to one share, we take $14.912 billion divided by 3.2 billion shares outstanding equals $4.66. This $4.66 is the net income per share, but investors also call it earnings per share, EPS. The earnings per share are nothing more than the total net income divided by shares outstanding. Now, to get our PE ratio, we take our EPS and divide that by the price. $59.08 divided by $4.66 equals 12.68. For every $12.68 you spend, you bought $1 in Walmart profit. Another way to look at it is you had an initial 7.9% initial rate of return, $1 over $12.68. Or if Walmart made the same income year after year, it would take 12.68 years to get your investment money back. As an investor, you want to get your initial investment back as fast as possible. That's why you should only buy companies that have a low PE ratio. But what is a low PE ratio? It depends on the stock market, the economy, the industry your company is in, and on the average PE the company has been trading in the past years. I've noticed that most companies I keep an eye on are trading at a PE ranging from 7 to 75. Most investors like buying companies that are trading at a PE of 20 or less. I only buy companies trading at a PE of 15 or less. Whenever the economy is prospering and people feel optimistic, they spend money more freely, and the stock market reflects this behavior. Companies start trading at higher PE ratios of 30 and up because investors bid up the price of the stock. This is when the market as a whole is overvalued. For example, company ABC is selling for $100 a share and has earnings of $4 for a PE ratio of 25. Investors start bidding up the price of the stock to $140. The earnings are still at $4, which gives us a PE ratio of 35. This to me is too high of a PE ratio. Like I said earlier, I only buy PE ratios of 15 or less. The opposite also holds true. Whenever the economy tanks, like during the Great Depression, people get real pessimistic about the economy and start selling their stocks and investments because they feel like the sky is falling. The stock market goes up and everybody jumps on the bandwagon and bids up the prices of stocks. The stock market is overvalued and the bubble is about to burst. Then the stock market tanks or corrects itself and everybody tries to jump off the ship and tries to save themselves. Now the market is undervalued. So in this case, company ABC went from $140 a share at its peak and tumbled down to $130, $119, $101, $80, $58, and then to $40. If earnings per share is still at $4, now the PE ratio is at 10. Everybody tried to get out of the market as quickly as possible because stock prices were falling. You will now see PE ratios in the single digits. It is at this moment that I shift into second gear and start buying companies like my life depended on it. I'm like a kid in a candy store, and the owner tells me that I can have all the candy I can put my hands on in the next 30 minutes. Remember, it's the shareholders who trade these stocks back and forth. The underlying company still is fundamentally sound and will generate profits and dividends for its shareholders. Also, most investors don't trade their stocks frequently. The average volume of shares that have been trading daily for Walmart stock is about 11.72 million, compared to 3.2 billion shares outstanding. That is 0.37% of total shares that are trading daily. The other 99.63% of shares are owned by investors who just sit on their shares and collect the dividend. Walmart PE was under 15 in 2009. Also, with a lower PE ratio, I can buy more stocks, which will give me more dividends. If I had $2,000 to spend and I bought company ABC at $140 a share, I would only be able to buy 14 whole shares. But if I bought the company at $40 a share, I would have bought 50 shares. Instead of getting 14 cash dividends, I now get 50 cash dividends. Going back to our Walmart versus Chevron example, it would be tedious to constantly have to calculate the market cap, share price, PE ratio, and EPS. Luckily, most of this information is readily available, and you can just look at the PE ratio without having to think about the calculation. See Figure 6.16, Walmart Investment Metrics. For example, Google Finance already has these numbers calculated for you. You can also add all the dividend calculations if you want to. Let's skip calculating Chevron's EPS and PE ratio, and let's just pull it from our online source. See Figure 6.17, Chevron Investment Metrics. Based on the PE ratios alone, I would buy Walmart instead of Chevron. Keep in mind that dividends are paid out of earnings, and if you look at both Walmart and Chevron, you see that Chevron is paying a higher dividend. Without looking at other factors, I would still buy Walmart over Chevron. A lower PE ratio trumps the higher dividend. One caveat when analyzing REITs is you should not use the EPS to calculate the PE ratio. You should use the FFO, funds from operations, or better yet, the AFFO, adjusted funds from operations. Your calculation will look like this: P over FFO or P over AFFO. When to sell. You will hear good news about a company, and the stock price will reflect this by going up. You will also hear bad news because a company might have missed its quarterly projected earnings by a few pennies, and the stock price will tumble down, or there might be some so-called financial expert who will tell you to buy a stock because it's about to sign a major contract which will boost sales. It's best not to pay too much attention to all this noise and focus on the financial data. When it comes to selling stocks, I only sell if a company stops paying the dividend, the company fundamentally changes for the worse, or if the dividend has not kept up with inflation. If a company stops paying dividends, it tells me that the business is in some kind of financial trouble and I need to investigate. Companies keep their shareholders happy when they pay out dividends constantly. It's a major problem if the company stops paying out dividends. The stock will most likely also drop in price. Not too long ago, I broke some of my own rules when it comes to buying dividend stocks and purchased stocks in a company called American Realty Capital Properties, ARCP. This was a monthly dividend-paying company, but it did not have at least a 10-year track record of paying increased dividends. I received my first dividend when the pay date arrived, but the following dividends never arrived. Management at ARCP was cooking the books, and when this was found out, all hell broke loose. The dividend was eliminated, senior management left the company, and shareholders were angry. Throughout this whole debacle, the stock price continued to decline, and it took a new management team and a change of company name to bring the company back on track. The company ended up reinstated its dividend 10 months after paying the last one. Looking back, I could have invested the money in a better way. But whenever you make a mistake, and believe me, you will make mistakes, just learn from it and move on. No use crying over spilled milk. Sometimes, companies fundamentally change by neglecting what they are good at or known for and instead jump into a new market. If a company you invested in is in the chocolate chip cookies selling business and all of a sudden jumps into fashion design and puts all of its energy and resources in building that up, it might not be the best use of resources. There are quite a few companies that buy out competitors or try something new. PepsiCo, for example, sells many different products. Besides the Pepsi soft drink, they also sell Lay's potato chips, Quaker oatmeal, Doritos, and more. They have a wide assortment of products, but they stay in the consumer staples industry. They don't stray away from what they do best. If a company has not been able to grow its dividend fast enough, you should either sell it or collect the dividend you receive and purchase other companies with it. Whenever I am not buying companies at a PE of 15 or less, I just sit back and collect dividends. Being patient and waiting for the right opportunities to buy is a skill in itself. As long as you follow the rules for selling dividend stocks, you will be able to tune out the noise. The worst thing you can do is constantly buy and sell your stocks, because this will hurt your overall return. Sitting still, not doing anything, and waiting for the right time to buy is a skill you will learn. Sometimes it can take months or years before you get the opportunity to buy a company you've been eyeing like a hawk at a low PE ratio. The fear of losing all your money. I've noticed that people have two fears. Either the companies they invest in going bankrupt, whereby they believe they will lose all their money, or the stock market crashing. Let's look at the first fear and how I deal with it. I only invest in high-quality, stable blue-chip companies that are not likely to go belly up and have been paying a consistent dividend for at least 10 years. Companies like Kimberly-Clark, PepsiCo, and Coca-Cola, to name a few. The chances of companies like these going bankrupt are not very likely because of their competitive advantage. To lower my risk even further, I invest in at least 30 great companies, and with the dividends I receive from them, I buy even more high-quality companies. By sticking to my rules, I don't even let companies that I invest in get up to a point of going bankrupt, because I would have sold my shares before that happens. Signs that you need to look at to see how the company is performing: revenue or net income declining, high debt, dividend cuts or freezes, and more. Reread the performance metrics I discussed earlier. My biggest hint at selling a company before everything else goes bad is if the company stops paying a dividend. That's an immediate death sentence. The reason for this is, if a company performs good or even mediocre, it can keep on paying a dividend, even if they might not increase the dividend amount by much. However, if a company that has paid a dividend for at least 10 years suddenly stops paying one, it tells me that they are having financial issues and more bad news might come to light soon. The company's financial performance is what I use to keep myself from becoming fearful. The second reason people are fearful is because of a stock market crash. When the market crashes, people end up selling their investments at a capital loss, turning their unrealized income into realized income. This is a fear you get over by accepting that the market will crash. There are periods when people are optimistic about the market and the stock market as a whole becomes overvalued. Then there are other periods where people are pessimistic about the market as a whole and they want to sell all or some of their investments, and the market becomes oversold. I wait for periods when the market is trending downwards, bear market, or crashes because I can buy these high-quality companies at bargain prices, which makes me able to buy more shares for my money, which also ends up giving me more dividends. Keep in mind that most likely the underlying companies are still performing great. It is the shareholders that own the stocks who are fearful and start selling, making the stock value tumble to a low PE. For example, around the time the market crashed back in 2009, anywhere from 35 million to 165 million of Walmart shares were trading, mostly being sold daily. That's still a minuscule amount of shares traded compared to the total shares Walmart had outstanding, which was 3.95 billion, that investors just held in their portfolios during the stock market crash. 165 million over 3.95 billion equals 4.2% of stocks trading. It is this 4.2% that impacted the price of the stock. Also, the best time for a company to start buying their shares back is during a crash, because they can buy them at a deep discount. Locating dividend-paying stocks. One way to find dividend-paying stocks is to look at products or services you come in contact with throughout the day. After you wake up, you go to the bathroom to brush your teeth, Colgate. You take a shower and wash your hair with Head & Shoulders, Procter & Gamble. Before heading to work, you eat a sandwich, Flour Foods. At work, you use your favorite calculator, Texas Instruments, to turn some calculations into a graph, and during lunch, you head over to Taco Bell, Yum Brands, for a chalupa and burrito. You will be neglecting plenty of high-quality dividend-paying companies if you just looked at products you or your friends and family use. So, another way to find dividend-paying stocks is to use an online stock screener. Google Finance and finviz.com have screeners that you can use to screen for dividend-paying stocks. Just do a quick Google search for stock screeners and you should be able to find plenty more. Here is a list of 36 high-quality dividend-paying companies that you need to take a look at. See Table 6.3, List of high-quality dividend-paying companies. DOV, Dover Corporation. EMR, Emerson Electric Company. WMT, Walmart Stores, Inc. AXP, American Express Company. TROW, T. Rowe Price Group, Inc. XOM, Exxon Mobil Corporation. EV, Eaton Vance Corporation. GPC, Genuine Parts Company. PM, Philip Morris International, Inc. CVX, Chevron Corporation. J&J, Johnson & Johnson. MMM, 3M Company. TXN, Texas Instruments Incorporated. MO, Altria Group, Inc. FAST, Fastenal Company. SBSI, Southside Bankshares, Inc. UL, Unilever. OHI, Omega Healthcare Investors, Inc. CL, Colgate-Palmolive Company. MCD, McDonald's Corporation. FLO, Flowers Foods, Inc. CLX, Clorox Company. KO, Coca-Cola Company. ADP, Automatic Data Processing, Inc. EL, SD Lauder Companies, Inc. MKC, McCormick & Company. PG, Procter & Gamble Company. PEP, PepsiCo, Inc. COST, Costco Wholesale Corporation. NKE, Nike, Inc. YUM, Yum Brands, Inc. HSY, The Hershey Company. WPC, WP Carey, Inc. REIT. O, Realty Income Corporation. RAVN, Raven Industries, Inc. KMB, Kimberly-Clark Corporation. Once I've found a great company that I want to buy, but it is trading at a high PE ratio, I add it to my watch list. This is a list of all the stocks you are keeping an eye on. It also has performance and fundamental information like the PE ratio. You should be able to create a watch list in your brokerage account. Google Finance also has a watch list feature called Portfolios. Rules are meant to be broken. Do I stick to all the rules I listed? No, life is no fun if you don't break the rules. I sometimes break the rules for some companies, but in moderation. I might look at a company like Disney, D, or Chubb, CB, that has a low dividend yield of 1%, but has a great dividend growth rate. I'm also very careful about businesses that sell commodities, but if I can find one that is holding a monopoly status as its competitive advantage, I might look into purchasing a few shares. Diversification. I diversify my dividend portfolio based on the 10 U.S. stock market sectors. Consumer staples. This sector consists of products consumers use on an everyday basis. Even in an economic downturn, people will keep using them as they are always in demand. They consist of beverages, food products, household products, personal products, and tobacco products. Example of some companies: P&G, KMB, PM, EL, CL, PEP, KO. Consumer discretionary. These are the non-essential products or services that consumers could live without. If the economy is doing badly, people cut back on consumer discretionary products. They consist of media, auto components, hotels, cruises, restaurants, vacation resorts, apparel, and cars. Examples: DIS, YUM, COST, MCD, WMT, FAST, GPC. Energy. Energy companies consist of the production or supply of energy worldwide. Example: KMI. Healthcare. There are a variety of companies in the healthcare sector: drug manufacturers, biotechnology, healthcare providers and services, medical appliances and equipment, and medical research. People always require medical aid, so this is a sector to keep an eye on. Example: J&J, PFE, ABBV. Financials. When you hear financials, you immediately think about banks. But this sector also consists of insurance, REITs, asset management, investment brokerage, and credit services. Companies in this sector do well when interest rates are low. Example: AXP, TROW, CB, O. Utilities. Companies in this sector mostly carry a large amount of debt. These are electric utilities, gas utilities, water utilities, and multi-utilities. These are often considered boring companies to invest in. Example: AVA, SJI, WTR. Telecommunication services. Telecommunication services companies have set up elaborate infrastructures that give us the ability to communicate with our family and friends all over the world. The biggest section is wireless communication. Example: VZT. Materials. The materials sector consists of raw materials that are harvested, refined, extracted, discovered, and processed. These materials could be chemicals, metals, paper, construction material, and containers. The materials sector is highly dependent on the demand for their products, which goes through cycles. Example: APD, XOM, CVX, HP. Industrial goods. This sector, also highly dependent on demand, consists of different companies in different categories: aerospace and defense, airlines, machinery, construction, railroads, electrical equipment, commercial supplies and services, building products, and industrial conglomerates. Examples: DOV, EMR, GE, CAT. Information technology. Tech stocks are favorite stocks of many investors because they are mostly growth stocks. People also like being associated with the coolest tech companies that are creative and always push the limit of what is possible. Competition is extremely high in information technology, and it's not unusual to see today's cool companies be tomorrow's forgotten relics. Many tech companies also don't pay a dividend because they'd rather use the money to grow the company. The information technology sector consists of software, hardware, IT services, communication equipment, internet services, and semiconductors. Example: MSFT, TXN, QCOM, CSCO, IBM. Weight by sector. Whenever you build a portfolio of securities, such as stocks and bonds, you diversify it and allocate weight based on your risk tolerance level. Someone younger is usually more aggressive and allocates more capital in high-risk, high-reward stocks. But someone who is less risky might focus more on safer investments, such as bonds and annuities. My portfolio weighted by sector. Consumer staples, 20%. Consumer discretionary, 18%. Financials, 17%. Healthcare, 14%. Industrials, 10%. Information technology, 6%. Utilities, 5%. Materials, 5%. Telecom services, 3%. Energy, 2%. Total, 100%. This is my portfolio weight by sector for my dividend stock portfolio. To be honest, I haven't been aggressively paying attention to it, but I always keep this in the back of my mind. If I had to start from scratch and had $10,000 to spend, I would use 20% or $2,000 and buy different consumer staples companies with that money. I would then take $1,800 and buy different consumer discretionary companies, etc. I would then have my portfolio weighted by sector. Consumer staples holds the highest percentage because it consists of companies that sell products that have a competitive advantage and sell well even when the economy is down. Consumer discretionary, even though it does worse in an economic downturn, I still make this a large percentage of my portfolio because it consists of many companies that have competitive advantages. Finance also makes a large portion of my portfolio focused on REITs, local banks, and credit services. I would like to make healthcare a larger percentage of my portfolio, but there are not that many healthcare companies that qualify based on my rules. I am careful with industrial, basic materials, and energy companies because most of the companies in these sectors are highly price sensitive and cyclical. Many of these companies compete to be the lowest cost producer, and price, therefore, becomes the biggest factor that drives performance. Utilities and telecom services also get a low percentage point in my dividend portfolio. High debt and high payout ratios make me keep these sectors to a minimum in my portfolio. Information technology also gets a low ranking in my portfolio. Most of the companies in this sector are overvalued because people bid up the stock price too high. These companies most often don't pay a dividend. Consistency is also an issue because these companies are so competitive that they have to be creative and change with the times. This makes it harder for an investor to analyze a company that constantly changes. For example, a boring blue-chip company like Philip Morris sells one of the most well-known consumer staple products called Marlboro. I'm pretty sure 30 years from now, PM will still sell Marlboro successfully. It's these kind of stable companies which give me the confidence to invest in them. Tech companies, on the other hand, change quite frequently and they come and go faster than I can keep up with them. Microsoft started as a software company that made money by selling and licensing out its products. Windows is what immediately comes to mind when you think of Microsoft. But in the following years, Microsoft has jumped in the gaming industry, phone hardware, cloud computing, and other avenues to keep up with the competition. Even though I have bought shares in Microsoft, it is hard to imagine what this company will look like 30 years from now. The S&P 500 is weighted like this. Information technology, 21.14%. Financials, 16.66%. healthcare 14.67%, consumer discretionary 13.08%, industrials 10.05%, consumer staples 9.69%, energy 6.68%, materials 2.85%, utilities 2.82%, telecom services 2.36%, total 100%. This is also what your portfolio looks like if you invest in an index fund like the popular VFINX. My biggest gripe with this weight by sector is that information technology has way too much weight. When the stock market corrects itself, the information technology sector will be one that will be affected the most, especially since it is overvalued. Consumer staples, the sector that performs well even in a downturn and consists of many companies with competitive advantages, has not enough weight. This also applies to the consumer discretionary sector. Diversify by adding non-US companies. Most of the profitable companies with brand recognition and a global reach are in the US. But that does not mean that Europe, Africa, South America, and Asia don't have high-quality companies of their own also. Sometimes you can find even better undervalued companies outside of the USA. Instead of sticking to US companies, diversify your portfolio and go international. I'm always careful when analyzing these companies because many companies overseas sell price-sensitive products, such as commodities or basic materials. I make sure to look for companies with a competitive advantage. Many companies have been developing at a rapid pace these last decades, such as Brazil, Russia, India, China, and South Africa. Make sure to pay attention to taxes you would have to pay on dividends that you collect from countries outside of the U.S. See Table 6.4, List of non-U.S. dividend-paying companies. I have noticed that countries outside of the U.S. most of the time are lax with keeping a good dividend policy going. These companies might pay an increasing dividend for a couple of years and then cut the dividend. I've also noticed that many companies pay dividends yearly or twice a year compared to the average quarterly dividend in the U.S. This is why I am also less strict when it comes to analyzing overseas companies. Resources. There are quite a few resources online that are available for free when it comes to analyzing stocks. I've made a list of the ones I use the most. Investopedia.com. Great resource for explaining many terms related to the stock market. They have helpful videos also. SeekingAlpha.com. Community of dividend investors who analyze and write articles about different companies. Finviz.com. Great site to use for stock screening, stock research, and keeping up with different markets and currencies. Morningstar.com. My go-to resource for financial statements. This site makes analyzing stocks so much easier. Google Finance. I always have this site open. It gives me a quick overview of different companies' stock information and stock charts. MSN Money. Similar to Google Finance, it has great graphs and stats. Finance.yahoo.com. Similar to Google Finance, always good to check out also. GuruFocus.com. Good graph site for quickly checking earnings growth, dividend growth, payout ratio, and more. Dividend.com. Contains stock dividend information. StockCharts.com. Charting site used to track companies. Case study. You will find how I quickly analyze a company step by step. The company we will look at is the Hershey Company. What does the company do? The Hershey Company, HSY, is the largest producer of chocolate, and they sell their products worldwide. Hershey's been in existence for decades now, but they also have the right to produce and sell certain products such as Jolly Rancher, Kit Kat, Rolo, Twizzlers, and Payday. Does the company have a sustainable, long-term competitive advantage? Hershey sells products that have built up their brand name. If you crave Kit Kat, there is no substitute. You have to buy Kit Kat. This also applies to the other products they sell, like their famous Hershey chocolate bars. 30 years from now, it's safe to say Hershey's will still be a chocolate confectionery, selling the same products they have for all these years. Is the company in a position to grow? Not only is Hershey's expanding their product line, but they also stay in the industry they are experts in. They also see future growth in South America and Asia. Are the total revenue and earnings consistently growing? Revenue has seen an average growth of 7% in the last 5 years, and net income has seen growth also. See Figure 7.1, Hershey total revenue 2005 to 2014, and Figure 7.2, Hershey net income 2005 to 2014. How is the profit margin looking? Profit margin has consistently been around 10% in the last 5 years and 9.23% in the last 10. Is the ROE healthy? What about ROIC? Both ROE and ROIC have been consistently looking great for the last 5 to 10 years, in the double digits. See Table 7.1, Hershey's ROE and ROIC. Is debt manageable? Debt-to-equity ratio for the last 5 years has been 1.48 and around 2 in the last year. Total liabilities over net income before taxes equals $4,174,454,000 over $926,875,000 equals 4.5. The company can pay all its debt, future interest expense excluded, in less than 5 years, which is good. Is the company buying back its stock? Yes, Hershey has been buying back its stock, leaving fewer shares outstanding and increasing ownership for its owners. See Figure 7.3, Hershey stock buyback, 2005 to 2014. What's the dividend growth rate? Hershey has been able to grow its dividend by around 11% in the last 5 years and over 9% in the last 10. See Figure 7.4, Hershey earnings and dividend, 2005 to 2014. The bottom line is the dividend growth. 2009 was the only year the dividend didn't grow. It stayed at $1.19, but in 2010, it picked back up and saw an increase of 7.6%. What is the dividend yield? Right now, the dividend yield is 2.68%. The combination of a dividend yield higher than 2.5% and an annual growth rate averaging 11% in the last 5 years makes this business a keeper. What's the payout ratio? The payout ratio has consistently been under 60%. It saw a huge spike in 2007, but was able to recover and stay under 60%. This shows me that the management is hard at work keeping shareholders happy. See Figure 7.5, Hershey payout ratio, 2005 to 2014. What is the PE ratio? PE ratio is at 38.92. After the recent crash, the PE ratio was bouncing between 20 and 25 for a couple of years and then spiked up close to 40. Normally, I only buy companies when the PE is 15 or below, but for Hershey, I'm willing to make an exception and buy at 20 times earnings, PE equals 20, or less. For now, I will keep the Hershey Company on my watch list and buy whenever the PE is lower. This should happen when there is a market correction or a crash. Analyzing companies gets easier the more often you do it. You will also start to notice patterns with companies in the same industry. Conclusion. This is the last chapter of the book, but it is the beginning of your journey to becoming a superhero. Superheroes possess extraordinary abilities and skills that leave the average human jealous, speechless, and in awe. They also have the uncanny ability to stay calm, cool, and collected in the face of danger, while everybody else is panicking. While doing their normal daily activities, they might also blend in with the crowd and not stand out at all. But when duty calls, they can switch into superhero mode as fast as lightning. Dividend investors are the superheroes of the investing community. They have the extraordinary skill to fly through cyberspace, analyze, buy, and sell different high quality companies without breaking a sweat. While doing this, they also receive realized income in the form of dividends even when they are on vacation, working, or hibernating. When the market crashes and everybody panics and starts to sell, the dividend superheroes stay calm, cool, and collected. And when the time is right, they kick it into awesome mode and achieve sensational feats that the average investor is too scared to undertake, leaving them baffled and scratching their heads afterward. Dividend superheroes come in all shapes and sizes, from the lightest to the darkest hue. And last but not least, they have the remarkable ability of blending in.